What's up, everyone? This is Tom Vilord from Wall Street Value. Hopefully you're going through the content that we deliver to you. Hopefully you're learning a lot. Hopefully you're enjoying it. And today what I want to do, I wanted to give you a video tutorial that explains how we go through the process of valuing a stock. Now, we give you all the details in the ebook, How to Value Stock Method Number 1. But if you're like me, it sinks in a lot easier once you see how it's done visually. So I want to share my screen with you right now. So we'll get into this. All right, here we go. When I first started to invest, when I first got started doing this, I invested in companies I understood, companies whose products and services I liked, and I would buy those stocks thinking that that would be a great investment. Just because I understand a company and I like a company doesn't necessarily mean it's a great investment. It could be going through some tough times. It could also be at a point where it's just extremely overvalued. So my results weren't that great. And then once I started learning the process a little bit more, started digging into the financials of the company, then I was able to determine, all right, this is a great, fundamentally sound business. It's run properly. Earnings are growing, sales are growing, everything looks good. But I still felt like there was something that I was missing. And what really transformed my investing is when a mentor of mine, Dr. Paul Price, he sat down with me and showed me how to value a stock. And once I learned this information, it just tied everything together. Because now I know what to look for in a great investment. And take it a step further, now I know what that great investment should be worth. Because once you know what something is worth, you'll know when to buy it. If you already own the stock, you'll know when you should hold it, and you'll also know when to sell it. Once you know this information, your investing will transform that, I promise. So this year, it's very easy. It's third grade math. It's extremely simple, but this information will transform your investing results, I promise. So let's get into it. So the first thing we need to do is go to Value Line. This is the resource that I use to find the information that we need to run this calculation right here. So go to Value Line. If you want to get a subscription on your own, that's great. It's a little pricey. I believe it's about $500 a year. I haven't paid for this in years, so I don't have to. My library has a subscription to it. So contact your local library and see if they subscribe to the service. If so, that's awesome. You can access all this content for free right from your home. So we go here to valueline.com, and I typed in the ticker symbol. So there's two companies that we'll look at today. The first one's got to be Disney. It's my favorite company. And the second one is USANA Health Sciences. I saw that one in Joel Greenblatt's Magic Formula Investing Stock Screener. They combine companies based on the highest combined earnings yield and return on capital score. And I recognize Health Sciences because I owned that a couple of years ago and did real well for me. So I want to take a look at that again to see if it makes sense to buy it a second time. Let's go to Disney. We'll do this one first. And what we want to do here is click this right here. This is the PDF reports. And we're going to go to the most recent one, which was May 5th, 2019. Now, I told you that it's extremely simple doing this calculation. It requires third grade math. There's only two things that we need to come up with a potential value using this method. And those two things are trailing 12 months earnings, or we can also do future earnings. I'll explain that in a moment. So we need earnings, and we need historical price to earnings ratio. That's it. Those two things, and we multiply the two together, and that will give us a potential target price. Now, if you don't know what historical price to earnings ratio is, what it means, why we use it, I give a pretty good explanation, a couple examples of how you use that in section number 5 of the Stock Market Basics course. And if you get a chance to take a look at the ebook that we sent you, I explain it there as well. So I'm not going to go over what it means here, but I'm going to show you where to find this information and how we use it to come up with a target price. There's two things that we need. So the first thing I'm going to start with are the earnings per share. We can use either trailing 12 months earnings per share or future estimated earnings. So I usually do this calculation to figure out what the stock price could be worth today. And so since we are in the middle of 2019, what we see here, these earnings per share, 845, these numbers are in bold. That means it's an estimate. That's what Disney believes is going to happen by the end of 2019. The year hasn't completed yet, so these are just estimates. So when we run this calculation, we're going to use this figure right here, 836, because that's what they actually did earn in 2018, the year completed. Now, when are we going to use this? Let's scroll down to the bottom of this page. What we will see is an earnings predictability score. So we want to calculate the future estimated value on a company who has predictable earnings. We consider predictable earnings when they have a score of 85 or higher. Disney does a pretty good job estimating where they think their earnings will be by the end of the year. So with this company right here, we're going to come up with two different calculations. We're going to use to figure out where the stock could be approximately today, And then we're going to do the same thing using their future earnings and see where the price of the stock could be by the end of this year. So again, there's two things we need: earnings per share and historical price earnings. We multiply those two numbers together, that gives us a target price. So there you have it. It's that easy. It's third grade math. The second and last piece of information we need is the historical price to earnings ratio. Now, what we see up here, let me scroll up a little bit. It says median 16. That means that's what their median price earnings has been all the way back to 2003. Now, normally, I'm not going to use this figure because if we go back to 2003, a lot of the companies that we're looking at are completely different now than they were all the way back then. Disney, they're a media company. They run ABC, they run SportsCenter, they run the theme parks, they have all these beautiful movies for children. They sell their Mickey Mouse dolls and t-shirts and other types of toys. Disney right now, even though the company has evolved and improved since 2003, they're essentially still the same company. The underlying business model hasn't changed a whole lot. So because Disney is pretty same now as it was back in 2003, we can use this median price earnings ratio of 16. Now, I wouldn't use it for a company such as Apple. Imagine a time when the iPhones didn't exist. Well, back in 2003, they didn't exist. They didn't exist in 2004, 2005, or 2006 either. So because Apple is such a different company today than it was back in 2003, I'm going to use a more current historical price to earnings ratio. So the three time frames I would use would be going all the way back. So I would use this median price earnings if the company is similar. So a company that would be similar, Walmart is a similar company now as it was in 2003. John Deere still sells tractors. Coca-Cola still sells beverages and soft drinks. These are companies that we can go all the way back to 2003. Another example of a company that I wouldn't use this for would be Amazon. I can't remember the exact time period, but right around here, 2003, I think Amazon was still selling books. That was their primary business. They were booksellers. They weren't the world dominator that they are today. So companies whose businesses have changed a lot over the last couple of years, biotech companies, technology companies, we wouldn't want to use the data going all the way back to 2003. So what we are going to use is the 5-year historical price to earnings and also the post-recession historical price to earnings. So that's going back from today all the way back to 2010. So enough of me rambling on. Let me show you how this works. So I'm going to pull up my drawing tools real quick. All right, so I'm going to highlight this right here. So we want to find out what the average price to earnings ratio is. What's that? It's a sloppy line. There we go. 1, 2, 3, 4, 5. So we're going to add these 5 together. And then we're also going to add these together right here, going back to 2010. We're going to add these 5 divided by 5. That's going to give us the average 5-year historical price earnings ratio. And then we add 2018 all the way to 2010. And that's going to give us the average historical price earnings ratio going back that far. So let me do one more thing real quick. Let me get out my text. And I'll write this down for you. What we have here is the current price, 134.07. This says 133. This was the report as of May 3rd. It's May 20th, so this is a little bit higher than where it was right here. So the current price is 134. If you take the current earnings divided by the current price, that gives us a price to earnings ratio of 1603. So how does this price to earnings ratio right now compared to history? So the median price to earnings going back to 2003, 16. So we're right about fairly valued. If we take a look at the 5-year historical price to earnings, 17.66. So based on the 5-year historical price to earnings ratio, Disney's a little bit undervalued. And then if we take a look at the price to earnings ratio going all the way back to 2010, the price to earnings average is 16.64. So again, very close to where it is right now. So Disney's not at a bargain. It's fairly valued. How do we know that? Let's do the calculations. So what we do is we take this right here, 16, and we're going to multiply that by the trailing 12 months earnings per share, which is 836. So if we multiply these two numbers together, the price of the stock should be right around $133.76. Pretty close to where it is right now. 17.66 times 836. So we're going to multiply the 5-year average historical price earnings ratio times the trailing 12 months earnings per share. That gives us a potential target price today of $147.63. So based on this price to earnings ratio, the stock is a little bit undervalued, but not quite enough. And then lastly, if we go back to 2010, we take this price to earnings ratio times the trailing 12 months earnings per share, we get a potential stock price of 139.11. So if we just average the three of these together, we get a potential target price of 140.16. I'm not going to buy a $137 stock if it can only get to 140. There's not enough profit there for me. And Warren Buffett says to protect us from inaccurate calculations or something happened within the company that we're unaware of, we want to buy with a margin of safety. He says buy with a 50% margin of safety. So based on where the price is today at 134 and where the stock price should be at, there's no margin of safety here. So we're not buying the stock. Now, let's assume there was a 50% margin of safety. I'm still not going to say go buy the stock. This is for educational and illustrative purposes only. What we're doing right here is to show you how to do it. It's not a recommendation to buy or sell a security. So this is how we figure out where the price of the stock could be today. Next thing we want to do is just verify that. So let's go over to Morningstar.com. And what we do is we go down a little bit and they give us what their target projection is. They think right now Disney should be valued at $130 a share. So according to Morningstar, the stock is overvalued. And we go one more place. Let's go over to Yahoo Finance. Type in the ticker symbol, stock's down a little bit. And if we scroll down, here's the summary page that we're on. If we scroll down a little bit, here is their price target. So they think the stock should be 149. Morningstar says 130. Combine the two together. Let's take the average as 139.50. And what did we come up with? 140. So it's pretty accurate. That is how you do it. It's that simple. I told you it's very easy. And there you have it. Multiply the trailing 12 months earnings per share by the historical price to earnings ratio. Now let's go back to this page. I showed you how to do all that using the trailing 12 months or the last year's earnings per share. Since Disney has a pretty good earnings predictability, we can use this figure right here to figure out where the stock could be at the end of 2019. So we can come up with a future valuation. So doing that, I am going to get my drawing tools out one more time. That's not what I wanted to do. This is what I want. So these are the figures that we're looking at. We're at the 5-year average PE and then going back to 2010. Here we have the numbers based on the estimated earnings of 845. Same process. We take the median price earnings going all the way back to 2003, which is 16, times the future earnings per share, the estimated earnings. That gives us a potential target price of 135.20. Right now, the stock is at 134. Take the 5-year PE. That gives us a potential target price of 149. The PE since 2010 is 16.64. Multiply that by the earnings per share. That gives us a potential target price by the end of the year of 140.60. If we take all three of these, we average them out, we get a potential target price by the end of 2019 of $141.67. Right now, Disney's at 134, so it's not a bargain. However, the purpose of this video is just to show you how to go into Value Line, where to find the information. So here's the average annual price earnings ratio. This is where we come up with the 5-year average PE, 2010 PE, which is the post-recession. So we come up here to get the median price earnings ratio, and we use those three, and we just multiply that by the earnings per share, which is down here. So again, I told you it's very simple. We're multiplying two things, price to earnings and earnings per share, and that's going to tell you where the price of the stock could be today. And if it's a predictable company with predictable earnings, that can give you a target price of where the stock should be by the end of the year. So let's go ahead and do one more. So again, I told you we're going to take a look at USANA Health Sciences. I owned the stock a while ago and I did pretty well with it. And I saw it on the magicformulainvesting.com stock screener, which screens out companies based on a market capitalization that you pick. And then once you pick that market cap, it's going to spit out the companies that have the highest combined earnings yield and return on capital score. And USANA Health Sciences is one of the companies on there. So again, we go to Value Line, type in the ticker symbol right here, and that's going to bring up the PDF report that has all the information that we need. Most recent report here was April 19, 2019. So this information is a little bit old. So Value Line will probably be updating this pretty soon within the next month. And make this a little bit bigger. So start off, we're going to look at the earnings per share. So in 2018, they finished the year earning $5.12 in earnings, and they're estimating they're going to earn $5.60 by the end of 2019. Well, if we come down here to take a look at their earnings predictability, their score is an 80. Our minimum requirement is 85, so this isn't as predictable as I would like. So what we're going to do is come back up here, and we're going to try to figure out where the stock price could be today and we're not going to figure out a future target price because they're not as predictable. So let's go ahead. I'm going to get my drawing tools out one more time, and we're going to multiply 512 times the median priced earnings of 14, the 5-year average price earnings ratio, 1, 2, 3, 4, 5, going back to 2014, and then the post-recession price earnings ratio from 2018 all the way back to 2010. So let's get out these numbers, do the calculation, see where the stock should be priced at. All right, so I wrote down these numbers. The current stock price is $76.25. Their trailing 12 months, or the 2018 earnings per share, is $5.12. The median priced earnings is 14. The 5-year average price earnings is 16.44, and the 2010 price earnings, what that means is going back from 2018 all the way back to 2010. So since 2010, the price to earnings is 14.08. We're going to multiply these historical price to earnings ratios by the earnings per share. So 14 times 512, that gives us a potential target price today where the stock should be at $71.68. Using the 5-year price to earnings, the stock should be at 85 today. And going back to 2010, the price to earnings ratio is 14.08. That gives us a potential target price today of 72.08. We average the three together, that stock should be right around 76.31. And look where it is right now, 76.25. So the current price to earnings ratio of 14.89 is pretty close to where it's been over the long term, 2010, and even longer going back to 2003. So again, this is a stock that is not at a discount. Buffett says we want to buy it and we have to buy it at a margin of safety. So if we're going to buy the stock for $76 a share, it should be worth a whole heck of a lot more than 76. If it's valued at 76, we need to wait for this thing to drop quite a bit before we buy it. So again, it's not a recommendation to buy or sell, but I want to show you how simple it is to do this. And once you start applying this, you will always know when you should buy stock, when to hold a stock. If a company's great, put it on your watch list. Wait for the stock to come down to a point where it does represent a discount. In summary, two things we need: earnings per share, historical price to earnings ratio. Multiply that together, and that's going to give you a target price. And as you can see, when we verify Disney with Morningstar and Yahoo Finance, and there's a lot of other ones that we teach in the course, their target prices are right in line with where our target prices are. So this is a very accurate method to value stock. So start applying this right now. Do this every single time you research a business. Now going forward, you'll be able to identify when a stock is at a discount, when it's on sale. If you get a hot stock tip, you can verify whether or not that's a stock that you may want to either discard completely or take a deeper look at. So hopefully you understand how to do this. If you have any questions at all, please send me an email, tom@wallstreetvalue.com. And don't forget to attend the weekly mentoring sessions every Friday, 12 o'clock p.m. Eastern Standard Time. So that's it, everyone. Thanks for tuning in. I'll see you soon. Take care.